Jim, what actually gets you up in the morning about this asset class? What do you actually like about private equity?
Well, I think at one level the returns have just been compelling, very certainly relative to the public markets. It's been a good place to be for the last 10 years if you're an investor, and what's not to like about that. And I think as well, the other thing which is just fundamentally at the core of it is you're in control. I mean, if you're a public market investor and you don't like what's going on, you've got one thing you can do. You sell the share, go away and try something else. Whereas private equity, you just have that element of control, which personally I think is just hugely reassuring.
But if we take it down to a personal level, what you get an IM, you get a data set. What excites you? What is the nugget you're looking for?
I think I actually look a lot at the individuals involved and the people and the personalities and the motivations of what drives them, because what you see with the very large and successful firms in Europe, which there are obviously a number, they actually all have a decent record of prior performance, a lot of experience. They have a lot of transactions under the hood, but this is a game of inches really, and it's the people that make all the difference. So trying to understand how they work together, how clear their strategy is, what they're really trying to achieve, how well they are able to execute on the investments that they look to make is the hardest and the most challenging piece of what we have to do, but also the most interesting.
So let's take it up to the macro level. You represent some serious pools of capital, some big asset allocators. The US had if I can be very broad brush, the US had a good crisis. Europe had a less good crisis. What are you advising your clients today about where to allocate capital?
Well, I think our approach has been to favour the US market, because we've seen just demonstrably better results there, and we've seen more money getting put to work, more money coming back, returns being strong. I think in the broader picture, Europe's been more difficult because, as you say, the crisis has been harder. So I think that the difficult question for us right now and for many investors is to say, we've been very careful on the European market, but at what point do we start to moderate the bet, and to what degree do we do so? And I think what you see in the conference today, and you feel in the market more broadly, is that people are beginning to make the shift and saying, the news out of Europe is generally improving. Market by market is all different, but generally it's getting better. Money's being raised, liquidity is being generated, portfolio companies are hitting the number and increasingly beating the number, which is all positive. So people are looking to put more money to work, but it does vary hugely depending on each individual LP and their position.
And the US, by contrast, what's your assessment? There's a lot of cash about, some great returns. There's maybe a touch too much liquidity?
Well, I think you've had a similar phenomena in some of the country markets of Europe, particularly up in the Nordics, where if something looks like it's a one-way bet, then generally the market will fix that for you, given enough time. And I think the States had clearly was in a good position, a strong position, and capital really flowed into it. And multiply that by the US credit markets being the biggest and most liquid in the world by a margin, and that's not helped asset prices in the States. So if you think about that in the context of where do we go from here, then I think it's easy to see why people would be getting a little cautious. And certainly when you talk to the major US-based GPs, they will say exactly that, which is it's time to be cautious on the new deal side and a good opportunity to sell assets.
So if there are arguments for relative value shift in the direction of Europe, again, to take it down to the micro, pretty much every European strategy firm, fund, will have had issues during the GFC. So what does that mean for doing due diligence for you and for your clients?
Well, I think what you as you rightly point out, you couldn't avoid it. Basically, almost impossible to avoid having some sort of issue. So how do they deal with it? And I think what you really want to see is how well did they look after what they had? How well did they protect value? And what were they left to work with when the dust settled? And how much have they been able to deliver from that as a result? And I think also the other thing that it really brings to the fore is the clarity of the thinking that was done at the beginning. So if institutions knew what they were buying, why they were buying it, was a strategically attractive business which would have a real sort of fundamental value going forward, then generally if they've had that starting point, then despite having a sort of impairment to the crisis, the starting point is as valid now as it was then, and it's just been a question of time being extended, if you like, but the business remains an attractive asset, and it trades out the other side. And what you see with these deals is multiples broadly being maintained from base cases, but just being held for 2 or 3 years longer, which is sort of the inevitability. And I think when we see that, we're much more comfortable than when you see something and it was never really properly thought through potentially at the start, and therefore the difficulty of the crisis has left it fundamentally impaired, and it's just going to be very difficult to get any sort of recovery of value. And clearly, the more the former, the fewer the latter is where you want to be.
So clarity of thinking, that is a really crisp, powerful phrase. So maybe just to close, can you give us if you were advising a new entrant, what sort of weightings to Asia, to Europe, and to the US at this point? Have you got a clean sheet?
Yeah, well, difficult to be specific on that, but I would say, thinking about it from the following way. I mean, the biggest, most liquid market is still the States. Europe is a meaningful piece of the puzzle, and the whole rest of the world, Asia piece, is still really quite small. So I think you would struggle to have a position which was not a significant exposure to the States and a relatively small exposure to the Asia Pac, rest of the world piece, and then Europe's kind of the plug in the gap. So you're still going to have a decent exposure to the European market, but it's not going to be enormous, and you're still going to have significant weight of assets in the States. That's just broadly the way it would come out, probably.
So should tell, here we are in the heart of Europe in Berlin. We should tell European managers to describe themselves as the plug in the gap.
Yeah. Sorry, bad language, but I mean, I think the European industry, it certainly feels like it's better. This today, in the last couple of days of the conference, the mood is good, the mood is positive, the metrics are all broadly going in the right direction. It is a cyclical industry. We've had a cyclical low point, so we should be, touch wood. It's all a bit shiny and plasticky here, but if there was wood around, it should be in a good position going forward. But the things that we can't legislate for are the things that you can never legislate for. It's something exogenous that nobody sees coming that puts us back in the difficult spot again. But if we can just keep that broadly flat and broadly in without any big risk, then managers generally are on the up and portfolio companies are doing better. So that's all for the good.
Great. Well, thank you very much for sharing your wisdom and experience with us today.
Pleasure.
Thanks.